This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 6, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 is holding a razor-thin lead at 769.79, barely above its own intraday low, while the Nasdaq is bleeding nearly a full percent. We are witnessing a sharp, violent rotation away from high-beta growth and into defensive havens, with energy crashing and healthcare stepping in as the market's new shield. Before we dig into the sector splits, let's look at the data hitting the tape today. We have initial jobless claims coming in at 8:30 a.m. Eastern, followed by productivity and costs at 10 o'clock a.m. Then, at 10 o'clock a.m., we get the wholesale trade report. These are the macro pulses we're watching to see if this rotation is a reaction to cooling labor data or just a pure style flip.
With the jobless claims and productivity data arriving midday, the market is essentially bracing for confirmation on the slowing growth narrative. If productivity data comes in soft, it validates the flight to safety we're seeing in healthcare and staples right now.
Let's set the scene. The broader market is mixed but fragile. The S&P 500 SPY is down just 0.2% at 769.79, but the Nasdaq QQQ is suffering a 0.9% decline at 717.3. The Dow Diamonds is holding steady with a 0.44% gain at 542.81. Small caps IWM are down 0.64% to 299.77, showing some relative toughness compared to big tech. But inside that aggregate, the story is defined by a massive sector divergence. The energy sector is the laggard at -2.7%, while the healthcare sector, is leading with a 1.27% gain. The technology sector, is down 0.53% despite being a strong performer last week. The VIX is sitting at 16.5, ticking up slightly but still in a low volatility regime. It's a stark polarization in sentiment. On one side, you have the growth at any price narrative collapsing. Look at Datadog, DDOG, down 14%, and Celsius Cell, down 12.2%. Those aren't just dips, that's retail panic and institutional liquidation. On the other side, Unity Software U is surging 14.3%. The market isn't rejecting tech anymore, it's rejecting unprofitable tech. The sentiment shift here is from speculative momentum to cash flow credibility.
And that credibility is the only metric that matters right now because the cost of capital is refusing to budge. The 10-year yield is at 4.63%. And the yield curve is flat at a spread of plus 0.45 basis points. When you have that kind of yield environment, Datadog can beat earnings by a mile and still get hammered 14% if the multiples are stretched. Unity moved 14% higher because they raised guidance. They gave us forward visibility, which is the currency of this market. Meanwhile, the sector flows confirm this. Capital is flowing into healthcare, the healthcare sector plus 1.27%, and out of energy, the energy sector minus 2.7%. This isn't noise, it's a structural rebalancing of risk premiums.
But let's not mistake this for a healthy adjustment. The VIX is at 16.5, which feels calm, but that's the danger. We have a flat yield curve, stagnant GDP growth at 1.5%, and sticky inflation at 3.46%. That is a textbook stagflation trap. The reason the energy sector is crashing 2.7% and QQQ is dragging is that liquidity is drying up in both cyclical and growth buckets simultaneously. The flight to safety into healthcare is just a delay tactic. When the yield curve stays flat and real GDP stalls, these support levels are going to be tested aggressively.
Grid, let's look at the technical damage. SPY is at 769.79, dangerously close to its 8/5 low of 769.51. Triple Q is at 717.3, well below its recent high of 728.54. What does the chart tell us?
SPY is exhibiting extreme fragility. At 769.79, it is just 0.28 points above the intraday low of 769.51 from August 5th. If that level breaks, we expose the lower quartile of the 10-day range, which starts at 729.1. We've seen exhaustion in the buying pressure. It climbed to 776.85 and is now retreating sharply. For Triple Q, the structure has fractured. It closed at 717.3, which is a clear break below the consolidation zone. The next major floor is the 8/3 close at 700.7. That's a 2.4% gap down from here. The volume on the downside, confirmed by the heavy gaps in names like DDOG and CLS, tells us sellers are in control. This isn't a pause, it's active distribution.
I agree on the distribution, but I'd add that the technical breakdown in Triple Q is being driven by the fundamental repricing I mentioned. When you have a 14% drop in DDOG and an 18.9% drop in APP on downgrades, you aren't just seeing technical selling. You're seeing the unwinding of over-leveraged positions. The technical support at 700 for Triple Q is theoretical unless those underlying constituents stabilize their valuations. Until we see volume dry up on the downside, the path of least resistance is toward that 700 mark.
Exactly. And from a sentiment standpoint, the VIX uptick to 16.5 is misleading me if I think fear is high. It's not. What's high is uncertainty. Retail is fleeing sell and DDOG because they're scared of the next earnings miss. But institutional flows are rotating into quality. The put/call activity I'm tracking isn't screaming for a crash. It's screaming for protection against volatility. We're not seeing systemic fear. We're seeing a targeted risk-off move in growth stocks. Let's zoom in on the Nasdaq Triple Q. It's down 0.9% to 717.3. Grid, you flagged the 700 level as the next floor. Is there any sign of stabilization there?
Not yet. The 10-day range for Triple Q is 661.14 to 728.54. Right now at 717.3, it's in the middle to upper tier, but the momentum is purely negative. It failed to hold 728.54 on August 5th and hasn't shown any bounce. To touch 700.7, we need a continuation of this sell-off. I am not seeing bid support at 710 or 715. The lack of a VIX spike means there's no panic buying happening yet. People are just letting their positions rot. Without a clear volume bounce off the 8/3 close, the technical case is strictly bearish until proven otherwise.
And that brings us back to my risk flag. The 10-year yield is at 4.63%. If Triple Q drifts towards 700, it's not just a technical break. It's a confirmation that the bond market is rejecting the equity valuation model. At 4.63%, discounting future cash flows becomes brutally expensive. The floor at 700 doesn't exist if the macro denominator keeps climbing. You're watching a candlestick pattern, while the entire mathematical premise for those growth multiples is cracking.
Shifting gears to the S&P 500, SPY. It's down only 0.2% at 769.79, holding up much better than Triple Q. Why is SPY resisting the drop when tech is getting crushed?
Because SPY includes the defensive pivots. Look at healthcare, the healthcare sector, up 1.27%. Look at staples, consumer staples, down only 0.5%. The S&P is weighted heavily toward these defensive sectors, which are absorbing the shock from tech and energy. Unity Software, U, is also in the index, and its 14% run helps cushion the bellwether performance. So SPY looks stable. But it's a stable ship, sailing through a storm where half the crew has already jumped ship. The breadth is terrible, even if the headline number is greenish.
I'd add that the sentiment on the larger cap names is actually quite neutral to bullish. NVDA is neutral with a slight positive lean in news sentiment, and MSFT is showing strong bullish conviction. The market isn't abandoning the S&P 500, it's abandoning the speculative edge of it. The sentiment data shows a rotation within the index, not a rejection of the index itself. That's why SPY is holding 769.79, while Triple Q bleeds.
Technically, SPY is in a tighter range than QQQ. Its 10-day range is 729.1 to 776.85. It's currently at the upper quartile of that range. The fact that it's holding near the high of the range, 776.85, while QQQ breaks structure suggests that the S&P 500 has more room to breathe. However, the proximity to the 8/5 low of 769.51 is the danger zone. If SPY loses that, we trigger algorithmic selling that drags the whole basket down. For now, the chart shows consolidation, but the risk/reward favors the downside if that 769.51 support flips.
Let's talk about the laggard, the energy sector. It's down 2.7%, the worst performing sector. SPECTER, you called this a leading indicator. Explain the risk.
Energy is the canary in the coal mine for global growth. A 2.7% drop in a sector as large as the energy sector isn't a blip. It's a liquidity event. Combined with the flat yield curve of plus 0.45 basis points, it signals that the market expects slower industrial activity. If energy is crashing, it implies demand destruction or oversupply that the rest of the market hasn't fully priced in yet. This creates a stagflationary feel, slowing growth but sticky costs. That environment kills multiples everywhere except in non-cyclicals. So yes, buy healthcare, sell energy. But know that the root cause is a macroeconomic slowdown that is currently suppressed by the low VIX.
I concur. The flow data shows capital exiting cyclical commodities. We saw AppLovin down 18.9% and Western Digital down 15.5% earlier. This is a broad-based risk-off in discretionary and tech hardware. The energy sector is just the largest component of that risk profile. The quality premium I talked about earlier applies here too. Companies with strong balance sheets survive the energy downturn. Leveraged energy producers get wiped out. The rotation is from beta to alpha.
Finally, let's look at the Russell 2000, IWM. It's down 0.64% to 299.77, holding up better than the Nasdaq. What's happening in small caps?
IWM is at 299.77, testing the 8/3 low of 296.22. Its 10-day range is 287.83 to 303.6. It is approaching the lower boundary of its consolidation zone. Unlike QQQ, which has broken structure, IWM is still testing support. It hasn't cracked yet. There is relative strength here compared to the megacap tech meltdown. If QQQ continues to slide towards 700, smart money might start parking funds in IWM as a cheaper entry point for domestic-focused businesses. But technically, 296.22 is the line in the sand. If we lose that, we open the door to 292.9.
The sentiment in small caps is less panicked than in megacap tech. Retail hasn't flooded out of IWM the same way it fled Sell and DDOG. Small caps are often viewed as value plays during rotations, and given the defensive pivot, there's a subset of investors looking at industrials and healthcare within the Russell for value. It's not a home run, but it's not a bloodbath like the Nasdaq.
Just remember, many small caps are highly sensitive to interest rates. With the 10-year yield at 4.63%, their debt service costs remain high. The fact that they are holding 299.77 is impressive, but it's likely due to short covering rather than genuine bullish conviction. I wouldn't call this strength. I'd call it resilience under pressure. Once the broader SPY support at 769.51 gives way, IWM will follow.
So, to synthesize, SPY is clinging to support at 769.79, QQQ is fracturing towards 700, and IWM is testing 299.77. The narrative is a defensive pivot from growth/energy to healthcare/staples. Let's get the final synthesis.
Here is the picture. Grid identified the technical fracture in QQQ below 728.54 heading towards 700.7, and CIPHER confirmed that this is driven by a fundamental rejection of unprofitable growth, evidenced by the 14% moves in DDOG and U. Meanwhile, Pulse noted that this is a rotation within quality, not a total market collapse, as evidenced by the bullish sentiment on MSFT, versus the bearishness on decentralized finance. However, SPECTER correctly warned that the flat yield curve and 4.63% 10-year yield create a macro ceiling that makes technical bounces unreliable. The consensus is clear. Hold the defense, the healthcare sector, consumer staples, avoid the high beta growth, triple Q components, and watch the 769.51 level on SPY as the binary trigger for the broader market's direction.
That brings us to our key takeaways. First, the market is executing a violent rotation from high beta growth to defensive quality, with SPY holding narrowly above 769.79 and triple Q breaking below key support. Second, fundamentals are king. Unity Software's surge versus Seldry's collapse proves that guidance and cash flow are the only currencies that matter right now. Third, the flat yield curve and 4.63% 10-year yield pose a significant structural risk that makes technical support levels fragile. Tomorrow, we watch the 769.51 level on SPY and see if the VIX expands beyond 16.5. Stay disciplined, protect your downside, and trade the data, not the hope. This is ShadowQuant Equities Edition. I'm your narrator. Remember, this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.